All right. Matt, the mortgage guy. In today's video, I'm going to talk to you about the Fed meeting, what Jerome Powell said, what he didn't say, how it spooked the markets, how it's going to affect interest rates, how you should think about it, or how it's going to affect you if you're a home buyer, how it's going to affect you if you're trying to refinance your home in 2022. All that and more ahead. Before I get into it, please like, comment, subscribe, do all the things for the YouTube algorithm. I'm just a mortgage broker sharing my experience talking to consumers, talking to real estate agents, talking to mortgage professionals day in and day out, using what I hear, what I see, what I feel, bringing it to you in real time, right? So on that note, today in real time, I watched the Fed speak. I listened to a little bit of it, didn't listen to every single word that Jerome Powell said, but I saw the reaction from the markets. In short, mortgage bonds didn't like it. Mortgage rates got worse. And I think what truly happened was Jerome Powell was a little bit more aggressive, a little bit more hawkish about how he talked about the future of monetary policy, right? And how he's going to continue to do that for the next 12 months, raise interest rates. Not only, does the taper of purchases end from the Fed, but also, the Fed funds rate. Never is going to give specific details, but in the Q&A, in the latter part of it, like somebody asked about whether it could be a 50 basis point hike, the first one in March, and he didn't necessarily say no. So anyhow, a lot of this stuff is not necessarily what he says, but what he doesn't say or how he says it, and they interpret it, right? And then the market reacts accordingly. So today, the day of this recording, the markets were probably 70 or 75 basis points worse at most lenders that I've looked at, right? All lenders are repricing for the worst. Truth be told, 75 basis points is probably only an eighth in interest rate. So you didn't see a huge move. You might have seen your 3.625 move to 3.75, or depending on your scenario and credit score, it went from 3.75 to 3.875. So not something that is necessarily going to change your specific scenario overnight, but how should you look at it going forward? What should you be planning if you're going to buy 3 or 6 months from now? My opinion is that due to supply and demand, home prices aren't getting any cheaper. And what we've seen from the Fed, what we've heard from the Fed and how the market has reacted, this coming off of very loose monetary policy that's caused interest rates to be super low, accommodative monetary policy. That's what they call it, right? Everything they've done to keep rates low, they're going to slowly ease off of that, right? So over time, rates are going to trend up. We've said that, we've heard that, it's happening, right? And so if you're thinking about buying, I don't want you to be panicked. I don't want you to be in a mode where you're just offering on anything and going out there and acting irrationally. But 3 to 6 months from now, rates are likely to be higher. 3 to 6 months from now, based on supply and demand and what I'm seeing in the market, only January, right? We're not even talking about a buying season where there's a lot of activity from buyers and it's already a madhouse, right? So home prices might become more expensive. So waiting is not the play, in my opinion, just one guy on YouTube's personal opinion. And, rates are going to continue to go up. Do they go to 5% by the end of next month? Very unlikely that happens. Probably not, right? But at the beginning of the year or the end of last year, everyone's predictions was like, hey, by the end of 2022, we might see 3.625, 3.75. Well, here we are 4 weeks into 2022, and we already there. So I think it's safe to say we might see mid fours by the middle of 2022. It would not surprise me at all based on everything I'm seeing and hearing and the Fed is saying and doing. And you're just going to have to adjust accordingly. If you're buying a house, you look at what you can afford, what fits in your budget, and you might look at a 3.75 interest rate or a 4% interest rate or 4.25, depending on when you buy. It's probably a good idea. Truth be told, if you're not going out and offering on houses this weekend and it's just you're planning to buy, go ahead and look at mortgage scenarios based on a higher interest rate than today's current rate. Example, if today you could get a 3.625 or a 3.75, look at your whole scenario and your purchase with a 4% interest rate. If you end up buying in February or March and it's 4%, you've prepared, you know what that payment looks like. If it's not 4%, if it stays flat at 3.75, then you're better off, right? But the worst thing is to plan for the best case scenario and then be disappointed, right? You might want to plan for the worst case and then be happily surprised. That's just my personal preference. If you're an investor or you're looking to refinance, it's the same game, right? You just have to plug in the new numbers, the new normal, the new reality. Interest rates are higher, and see if the investment makes sense. See if the refinance makes sense. I can tell you based on data, an analytics department at a huge hedge fund, I talk to them probably once a month. There is very few people that still have enough, what do they call it? They call them in the money when there's enough benefit, right? Like a 50 basis point benefit for a refinance on a rate and term, that's evaporating, right? Like that's less than 20% probably after today's little nudge up. So there's not going to be a lot of people that are going to see a benefit from a rate and term refi. Still, if there's a life event, there's a divorce, there's cash needed for, emergency remodels or for some investment opportunity, like that's still going to happen. But refinances are going to be a lot fewer and far between. You need to analyze that based on a higher interest rate and make sure it makes sense, right? What you don't want to do is go from a 2.75 to a 4%, pull $14,000 in cash out to pay off a credit card. That doesn't make any sense at all, right? Find another way to pay off that $14,000 credit card. Keep your 2.75% interest rate. Don't let anybody talk you into that. And I've got numerous videos about call center lenders that are going to be desperate. They're going to be thirsty and they're going to be calling. So avoid that. And all the investor clients I work with, you used to be able to get investor loans in the 3s. That was yesterday, right? If you want them in the 3s now, you're going to have to pay a hefty price. You're going to have to pay some points, but that doesn't mean there's not deals to be had. Deals that I made in 2019, I had to use financing that was in the 6s. The deals still made sense, right? And if the deal makes sense at a 5% interest rate, buy it at that 5%. If sometime in the future you can refinance it lower, great. But if not, you've underwritten the deal and you figured out that the deal makes sense at 5%, at 4.5%, at 4.25%, wherever it's at for that investment type loan. So that's my, quick take on the Fed meeting, what I think, what the future brings, all the projections about rates, 3.75-ish by the end of the year. I think most people are going to have to readjust those, right? I would say 4.5 to 4.75 is probably a more realistic end of year number for where, primary 30-year fixed rates are going to be without paying points, but who knows? I've been surprised before. I've been wrong before. That's just my best guess. If you'd like to get in touch with us, we'd be happy to help. Go to greatmortgagebroker.com. Let us know where you're at, how we can help, what questions you have. We'll be happy to reach out to you. Again, greatmortgagebroker.com. And until next time, we gonna see.